Yeah, back to business. So we were just talking about a NASDAQ. There you go. Right, so we were just discussing NASDAQ trades, so perhaps come and touch on that in a bit. See how that is getting on. The idea of this being a reversal. Right. I'll bring up. Where's he gone? There we go. Bring that up. We'll try and make a bit of sense as to everything that has happened. So I'm just trying to find my page. So if any questions do come in, I can answer them. I'd love to know, Darius, how this trade went. The plan being sell 10 at 60.29. If it hits no pullback, should have little enough momentum that I can reevaluate and get out without a large loss. Okay, so that's an S&P trade. Did we trade 30? Oh, you should be very happy with that. I think that's traded it about to the tick, perfect. So, yep, it's followed exactly your idea that it's probably not going to have enough to keep on going. Okay, cool. S&P buy 6 at 65, 6 at 50. Look for a quick fade if CPI is 0.5 or no sign of a pullback. Oh, sorry, if it's that big and no sign of pullback, get out. The only thing I'd say on that is if you're looking at the S&P to go that far, I would suggest that the data is going to be significant enough that it's not likely to come back. As in, if you can get as far as 50, probably a bit of a stretch. Sorry, just put the chart up, which makes this a bit easier to read. There you go, and it's by magic. Piss. Right, yeah, on that, I think that for a quick fade, for the S&P to do 50 handles on the data, yes, it might work real quick, but to get that far, I think it had to be pretty far aligned. I think without a 0.5, there's not a chance you'd even reach that. Preemptively short NASDAQ at 29,975 is at $470 as entered, then watch momentum and decide. If you're fast enough to hit it, add and then scale out as it goes down. No stop, manual stop loss. If 0.3 or less, worst case risk is recent high on 3, which is 615. Unlikely in that case to try and add 6 to 9 contracts to take any pullback before the open. Okay, like I said before, my issue with going into the day to a position is you're just opening yourself up to a risk that you don't really need to take. You know, you reckon it's going to cost you 618 if it goes wrong. Fair enough, but is it worth 6? You know, if you've got a daily stop of 1,000, which would be what you'd have as a newer trader, are you willing to risk 2/3 of your daily stop on the possibility that you're right? Because if you get it wrong, you're just going to find it very, very hard to actually make any money back on the back of that, or well, you're digging yourself out of a hole. Focus on NASDAQ. If S&P limits are hit, take profit, even if imperfect, so I don't get distracted. Cancel the S&P limits after 30 seconds to a minute if not hit. I think what's fair enough, cancel them so you don't get distracted. If you're in the NASDAQ, the trade's there, you're on the trade. Your focus probably needs to be more the other way as to whether you're getting filled. My take on this is the idea is fine that it's a fade of whichever direction, if that's the way you want to play it. I think you're asking for too much, both on the upside and the downside. For the S&P to do 30 handles in the first minute on it, maybe just about, but it was hard, well, my view was before this, it was hard to see how the S&P would go that far on anything, even if it was lower. I think you were reaching the peak of it. So I think it was an unlikely one to be able to reach it in that first minute. So this was then the plan with the NASDAQ, and then what to do on each of them. So start by being short the S&P, stop short, look for a short fade, scale in short if too fast to stop loss. I think if you're going to go into this short, what I wouldn't do is on a lower number then stop out and then try and get back in. You're better off to just go, well, I'm in now, add to it and try and play that, because if you don't take the loss, you may not ever have to take the loss. What I mean is, you know, if you're short here, it goes up, you take the loss, then it goes up and back. Well, you've taken that loss and now you're just recovering the loss if you get the move back. If you're willing to take the risk of staying in on the move anyway, if it's going to do that, you're better off to just stay in and sell more. If you believe that this is going to come back from a jump up, don't get out and then get back in, because all you're doing is just banking losses that you don't think you're actually needing to take. So let's say it becomes a dangerous game, because if it doesn't come back, you've then sold, you're proved wrong, at which point you've lost yourself too much money. You can't keep on going for the day. That's the problem that you have there. Took a fade to about 21,176 in NASDAQ, similar fade to S&P, and then started scalping NASDAQ. Okay, fair enough. Right, in terms of the data, didn't see any other plans come in, but it was all in line, so I would put that very much in the danger zone. This is where your assessment as to what's going to happen is ultimately what guides what you do. My view was I didn't think that an inline would be that significant to send these markets up and up and up. My assessment was wrong. So that is then one that you can go back on and go, well, perhaps there's an element of the plan that wasn't quite right there. Maybe, or at least going forward, the interpretation could be, well, actually the market is still quite sensitive to basically, as long as it's not going higher on inflation, it's dovish. So the sort of bar for a dovish reaction is much, much lower than I initially thought. That's what you have to, that's the way you've got to try and look at these types of things. In terms of pricing on that as well, because this will be the real telling point. Yeah, they've actually gone from 65% priced for a cut to 80% priced. So it's very clearly taking this to be, we believe in a cut as long as nothing changes that. So the pricing actually really probably suggests that everyone thinks they're going to cut, and unless you get something really clear the other way, you just, what was happening, and I remember Jamie's very good at this, he was explaining the whole idea that the pricing of, let's say, 65% probability of a rate cut in December is not that people don't believe there's a rate cut, but you've got to price the possibility that results come a certain way that would mean a rate cut won't happen. As you move past each of those points, CPI being one of them, then you take away the element of that pricing that is leaning you towards no cut. And so that's one down. Now we've got CPI and payrolls left. You could effectively say each of them is worth 10 basis points at the present moment. If they come in line, well, that takes another 10% price towards a cut. If the next one comes in line, another 10% price towards a cut and fully prices it. That would be the kind of interpretation. Certainly my interpretation now off the back of this. Right. So not the nicest, but I think hopefully it certainly gave everyone an opportunity to have a go at a trade on it. I've got all the charts up there. I'll show you the recording of this in a minute. What did everyone trade on it? I don't think anybody put much in online on it. You guys all go S&P, apart from NASDAQ. Always the NASDAQ, always short. Fair. Anyone else? No trade on it, apart from Joey's gold.
But I didn't get time.
Ah, right. Yeah, I think, well, yeah, bond works quite nicely. I think, yeah, all the bonds actually went pretty well.
Tino was good as well.
Yeah, it's just whether you believed in it, because my thought was it reached some of the levels I talked about before, and it didn't fade, it just sort of sat there and went up. But I'll show you that on the video, because there was definitely a point where I felt it, and you always get this on data, you get the move, then it sits there, and that's your kind of decision moment, where I think you have to back your idea. If you think it's going down, it falls out of that and it rolls over. The S&P kind of lived up to expectation that it gives you the move and then dies off quite quickly. Yes, it continued, but it's only continued 4 handles from the peak of the initial move and then rolled back. Gold didn't do anything. I was quite disappointed in gold on that. The Euro's completely lived up to expectations and done nothing at all. Well, I say nothing, it's not gone down, or at least it hasn't at the moment. So it's maintaining that double top, double bottom play. It's done that, but apart from that, it's done very little. It's done its standard sort of 25 tick jump or drop, whichever way it goes, and then chop. There's not a great deal to be said for really what most of them done. You're moving on now to the kind of structure type trade where you've then got to ask yourself, well, have we moved to a point sufficiently that is going to allow the next leg of the move, and what is the next leg? My view on the S&P is that as long as you're above 13, the next leg could still be towards the upside, because you've not given it, it's not had the chance to go down, or it's not taken the chance to go down. So whilst it's up there, I think the upside is still pretty viable. Incidentally, we just opened. We opened at 15, so it'll be really interesting now S&P, what it does at 13, and then the other point is about 06, 05, which is virtually the start of the data move. Reason for that is that was the low of yesterday's value. It was the low of Friday as well. So that would be why I'm looking at 06, 05 area in the S&P. But structurally, I think the S&P looks okay now to go towards the upside. And it's got to do a fair bit to believe it's going down. I wouldn't rule it out. I still think you're back to the same game as before, that 93 and 86. If they break, then you get the flush out of the shorts, or sorry, flush out of the longs. Gold, I don't think it's given us anything. Gold's basically where it was before. So unless anything dramatically changes for gold, gold needs to take you somewhere to get you to think that there's anything to be done with this. Otherwise, it's just more of the same, sitting in the range, doing very, very little. It's really tightly packed in the range. I think you could look at gold now and say, well, 14 and 22, which are that low, and up here, the top of this range, might at least be your trigger to try and attempt the high of the initial data, or attempt to move down. Outside of that, gold's over, that's nothing. The euro, I'd be inclined towards the upside now on the euro, because it's maintained that double bottom. So you can go, well, if it was gonna go down, it should have taken that chance, assuming it's still up above 44. If it falls below 44, I don't think there's anything to be done. It's just a question of whether it really has the legs to actually reach the lows. Otherwise, euro looks like a very balanced day. So below 44, it doesn't look great. That looks like a continuation of a total chop. Above 44, and I think you can go towards the upside. Right. Treasuries were the ones that surprised me, I must admit. I didn't think you'd get that level of continuation in it at all. I thought you'd get this quick whip up, pull back, and that would be it. 2 year, I thought 23 looked like a reasonable short. 10 year, I thought 29 looked like a reasonable short. And I don't know if they've all broken it yet. Well, 29 might have held now in T-note. Yeah, it's touched and it's started to pull back, but it's hardly turned over. But structurally, we could still possibly see that. I don't think we've really changed. We've not changed enough structurally to really change the overall picture in treasuries, I don't think. But it's increasingly moving in that direction. I'll ping up the video in a minute. Be interested to know online how everyone got on that, and hopefully people did all right on it. Something I've sort of put this together just now as a way of tracking these types of things. So this sort of new variation of it, and people will go through all sorts of different iterations of tracking data. But I thought this might be quite a useful thing for people to do. You can't answer the structure bit yet. You're going to need to know about it. You're going to need to look into that later on. But I thought a way of trying to track this going forward in terms of the actual tradable part of it. So the initial reaction, I'm terming the first minute, just to give you a bit of a sense as to what you're looking for in terms of initial movement and where you can get into the trade. So what I've done is I've got the first spike, number of ticks. With the S&P, I've done that in full ticks. You obviously can't be super accurate on this because it's very, very thin. So you're looking at it approximately those ranges. The size of the pullback, and then if it breaks the initial flick up and pull back, how much does it break it by? I'm talking within the first minute, because the bit that you can never get really from a chart, unless you get sort of a 5-second or 15-second chart, is quite the sequence of that first minute. If you do it like this, then you can look, okay, right, well, if I'm buying a pullback in gold, I want to be looking at least halfway back. Same with the S&P, the 5 year less so, sorry, not the 5 year, the euro less so. The euro didn't come back very much at all. And then you're looking at how far, not from the break of the high, but and you can work the break of the high out, if you will. There's 3 back, and then it breaks from the low, so it'd be 17 ticks through the high of the initial move. But what you're looking for is, well, how much can you get out of it when you get in on the pullbacks? The other bit is then, if you get a continuation in the next minute, so the next minute candle continuation, do you get one? If so, by how many ticks? The S&P did half a tick through the initial first minute high. Nothing else broke the first minute high. So that then takes you onto your second wave. What I've done there is tried to split it up. If you get a continuation, it's there. If you don't, it's the others. So the pullback from the high is how far do you come back before you get a continuation of movement? You could look at second wave as being 15 minutes if you wanted to try and put a bit of precision on particularly on the extent of the move up. So it'd be pullback from the high, the peak of the continuation, which again you would do from the low of the pullback. If it's a range, then you know it's a range, and how big's the range, so that would be gold would be a range one. The S&P was a pullback, treasuries were a pullback, euro was a range. Size of the range. If there's a reversal, again, none of them were. How far past the scene of crime did it go? What you'll do if you do this over and over and over is you start to build up a picture that perhaps certain markets always reverse, certain markets always continue, or they always break that first minute high. And just by setting it out like that, you're able to sort of keep this track of what goes on. It helps you in future then go, well, next time we're going to go for this one, or I can at least always look for a break of that first minute high in the S&P if that's the case. You could add other bits in terms of the time, as in how long it took to do the pullback. All of these happened within about 5 seconds. So that's generally my kind of timeline or time zone, time frame. I'm thinking about 5 seconds from that first ping back, and where could you get in? You've got to look at it as well from viability of the trade. There's no point in going, oh look, it came back 40 ticks, but that 40 was literally just a flash down, because you're never getting that. You've got to see it like trade back, and then you can go, yeah, that's where you could get in. So you have to have, with any of these types of things, an element of discretion. But you've just got to remember that all you're trying to do really is judge whether you should be executing in which S&P or Day18 or whichever next time, and roughly what to expect. It's never going to work perfectly, but you're just giving yourself a sense of, well, probably if you did this for the last few in the euro, you'd see that there isn't a great deal to be done on it. And you'd be quite quick to go, oh look, it just falls into a range. So forget it if you don't hit the first move. If you go for the S&P, then you start assessing whether there's much to be done after that as well. I'd also add a bit of a write-up in terms of what happened, how it traded, how it did the moves that it did. The S&P's traded 13s or 12 and is now sitting on, well, starting to look possibly to the upside. I'll ping the video up. This is how I sort of tried to go about it. Excuse me. Oh, excuse me. Okay. So, standard approach, 30-year, 10-year, 5-year, 2-year, S&P, gold, euro, bund, ZQ. ZQ barely moved on this. It wasn't overly noticeable what happened on it. I'll start it off. My main kind of idea on this was gold on a break of 18, so I got that as a bit of a level in gold. And on the downside, I can't remember what I put down as my level in gold now. Downside was 11, I was looking for in gold. So the idea was break 18, buy it. The next levels I had in gold were 23 and 33 were my next targets towards the upside. So that was the main plan, buy gold on the break there. I'd got some offers in the treasuries to try and sell on a flick up, because I didn't believe that an inline or a small miss would be enough to keep it going. So the idea was offers in treasuries for any kind of whip up and back, and equally some bids on ZT, because not ZT, ZN. The 10-year seems to not be as weak as the short end. So I thought as well, if you end up with a higher number, the 10-year might still ping down and bounce, whereas the 2-year, I wouldn't trust it to bounce at all on that. So that was the idea. The 10-year's got bids and offers. The 2-year and 5-year have only got offers on the basis that I think they're going to flick up. Nothing on the euro, because I don't think it's going to do anything. Like I say, gold's the main play. Looking back, probably should have put more focus on the S&P and just gone for the, like I said before, break 13, it's a buy, break 93, it's a sell. And gone for that, which is basically the same game as playing it in gold. Right. I'll play it through for a bit and then try and explain some of the other bits after that. But there you go. See, it's not that quick, which is then, so watching for where that pullback is to then go and try and hit it. So got 18.8. The S&P's then trading 13. That probably was the one to have gone for the break of 13 there. With gold as well, by the time you've then read the data or read the number, you can then look at this and go, do you know what, that's in line. There's no point in aiming at 33 it's going to be a real big stretch for gold to do 180 ticks on an inline number. So if you can get 50 or 60 ticks out of it, probably good enough. You see the temptation to buy it, and then there was a second thought of actually probably isn't such a big deal this. The S&P was definitely the one that took this best, which sort of still suggests that people are very, very keen to buy it. But it was over quite quick, I felt. Certainly in terms of that, the ability to do anything early on, I thought it was over pretty quickly. The treasuries, I then thought, well, that looks like it's probably about it, and you start to see this larger order chase the 2-year down. So my sort of plan there was, well, this could be the beginning of a rollover. It's done one move up, stalls, starts to tick back, and my thought was this can go down now. What you start to see, and this is the bit I was talking about with post data, you'll always get this point where particularly the treasuries do it, because they will take out a large amount of space with very, very little trade. You get this very quick move up, and then it starts to build volume up here. This is your kind of decision zone now. Break it to the upside and onwards you go, break it to the downside and the reversal comes, and that's the whole idea of it. What I mainly want to be looking at for these types of things, or these types of breaks, and this is why I try not to recenter too much, is to try and work out the point where they all seem to go together, because at this point the 30 years sitting right at the bottom of that, the 2 years sitting in the middle of it. You want them all to get to the same point really, and then all move together, which if you're short, you certainly want to see the 2 year down here with everything else. And this is what will happen, that if you've got part of it, say the 2 year up here, the longer end's really going to struggle to go and break down without them all being together. Likewise, the 2 year's not going to go flying off through the highs without these all ticking up. So you're kind of at this at this sort of inflection point now. Now they all start to come pretty close together. And this would be the bit that you're waiting for, that they all get sort of stuck quite close together. So you've got sort of 28, 21, 21 and 21 in all of them. What you're looking for, if you're long, you want to see them all just go tick, tick up. And if they all tick together towards the upside, which you start to see that we've moved away from 28, 21, 21, 21, they're all starting to tick up. Once that starts to happen, that kind of sets the tone for the next bit of direction, which obviously ruins your short. And really what the play should have been here is once you start to take out that large order, the 2 years being the strongest on this so far. So that's the one that you want to be less willing to stay in if it does start breaking towards the highs, because it's these ones that are the struggling ones. So if you're going to be short anything, you probably more want to be short the longer end here, just on the way that it's traded. The short end there, you probably want to get out. There's two choices. My choice was, I thought 23 was a sell anyway. So my idea was it would trade 23 and then come back, because I still wasn't convinced it was going up, which obviously did not transpire. So the trade didn't work out. But that was the kind of idea behind it. You sell 23 and it rolls back. As it happened, it traded 25 and has then just stabilized. So even if it didn't give it up, it never came back on it. But you see now the 2 year breaks the high, the 30 year doesn't, the 10 year doesn't, the 5 year does. So the 2 years lead in the move up, which also leads the S&P. So the S&P's followed the 2 year. Everything else has kind of just died. But the gold, this is the one we were talking about, of playing the gold back through the range, which is done previously, that kind of jump and then roll over. Didn't do it. It ticks up, you have to give that one up. But that was about it. After 5 minutes, there wasn't that much left to do in it. It's a bit of a shame, because you want them to, you want it to do loads and offer you tons and tons and tons of opportunity, but it didn't do it. And then it's just on to the sort of wider structure idea after that. How did your gold trades go, Joey? Yeah. Oh, is it back towards lows?
It's gone through, yeah.
Is it? Oh yeah. Here we go. I'll bring gold up because there's not much left to say on that one. There you go. Well. Yeah, it's consolidating just above that low now, isn't it? There you go.
11.6 and 2.6 maybe targets.
Sorry?
I want to see 11.6 go.
Yeah, I agree.
2.6 maybe, or what? That's just a long-term target.
I
don't know if we'll get there. I think this is definitely going to go up in the long term.
Yeah, but you're looking right now. Yeah, I think what you want to see on gold here, You want to see just get a little bit more of a push through here, not this kind of just dilly-dallying at the low. Yeah, this is the point where it should go now. If you get through 11.6, then 06 is probably quite reasonable.
Got a bit of 210, shall I take it off?
Sorry?
Just got a bit of 210.
210?
Yeah, just a round number, but I want to see that exhaustion anyway. Just flush everyone out before we go on.
Yeah, I'm not sure where 210 is.
Yeah, it's 260.
Huh? Do you mean 2600?
2610, yeah.
2610? Well, yeah, if you're just trying to play for the flush out, oh, accidental short there. Well, we'll see how it goes.
Right now.
It's not really giving you a flush out. So if you are short and you're waiting for this to flush out, it's hardly doing it. It's just ticking lower. So if you're short, there's not a great deal that suggests it's going up here. It's not great if you are short just here. It feels pretty uncomfortable. Now it's starting to have a little bit more of a push. Yeah, still wouldn't call that a flush out as such. I think it's a bit more of a... Sorry?
I was leaning on the euro too, which is...
But yeah, I think that's probably got to be your target now, to get down towards 06.6. And then if you get through there, then you're back onto this kind of... You could probably draw the trend on it there. You got this kind of flag forming. So that, I think if you're short, where are you short from?
I'm out now. I'm not sure, like it took me a lot of attempts, but like the teens or 20s, or 19 or something like that.
Right. Yeah, I think, yeah, you look at that now, you think, well, there's potential now. If this starts to go, get through 08, get through that 06.
I think you might just be stuck in that range there though if you get back into that now.
Well, get stuck in this range. Yeah, there's the thing that makes me...
You could go straight through it.
That's the bit, yeah, and there's like the fact there's going to be a lot of people looking at this as possibly a sort of flag on that big move. You might, it's the kind of what I call your last chance. Like if you're going to try and stop this going down, you really don't want it down into here. But yeah, it could. I think you've got to play it on the belief that it won't. And if it gets through there, then yeah, I think you take that at 03. Sure.
Really
Yeah. Well, you've seen it enough recently. Surely you're just looking for the same repeat again of another one of these huge drops. So this is where you've then got to get your plan together if you're short as to what are you trying to achieve. Because if you're playing for the big one here, you can give yourself a bit of a bigger stop. You know, getting stopped out up here, say 12.5 is probably worth it. It's 20 ticks. If this is going to go and take this out, once it's through there, it shouldn't really be coming back, in which case you can go, well, I've taken a 20 tick risk to start with. Once it's through 07, I think you could potentially move your stop down. If you want to give yourself enough space, move it down to sort of just above 10. So you're basically on a scratch. But at that point, you then got to start thinking, right, what are you really trying to get out of this? If your plan is, I'm playing for the lows, don't then start going, ooh, it's stuck at 06, maybe I'll take it. Yes, you're 40 ticks on side, but if you think this is going for the big one, 40 ticks is nothing. Yeah, even just to get to the lows down here, that's still 95. So you've still got another 100 ticks to go just to get to the big break, which yeah, you can't rule out looking at what it's done recently. It'd be very hard to go, no, surely it can't do that. It absolutely can. It's just a case of whether it's really going to do it. You've got a little pocket of low volume here as well, so if you want to be really bold on it, you could probably have a go at selling here. It's not really doing much pace-wise.
It's really bold.
Sorry?
It's really bold, yeah, but I think that might be it, really.
Yeah, you decided? Would you buy it? I think that's the question, yeah. Yeah, I wouldn't want to buy it there. It doesn't mean you should, but this is the question you have to ask yourself, right? In terms of what are you trying to achieve on this trade, if you thought 06.6 is probably about as far as it goes, then I think you probably got to just get out. If you're willing to let this come back here, that implies that you think there's more to this. Otherwise, why are you letting it come back? There's no point. Just get out at 06.6. If you think there's more in it, well, then it begs the question of what more do you look for? 98.6 would be your next decision point. If it gets through that, it's all looking good. Just time. One thing I would be really looking forward to, for want of a better word, if it can stay down here till the turn of the hour, you might get this push on the turn of the hour. Yeah, People try and get that bigger move.
The bonds are holding high too.
Higher, that's not what you want. And that's your hourly. So yeah, if you get on the turn of the hour and you get it kicks through that low, then you could see how this could be the first of say 3.
Doesn't it, really?
Yeah.
Like textbook, isn't it?
Yeah, exactly. Fail break of the range,
Yeah.
complete rejection.
Yeah.
You just need one more close down here on an hourly, and you could, you start looking at something like that where you get hourly and then you get the next ones down after that. I think you've probably got similar up here as well. The only thing you don't want is that, where it sort of prints you a nice hourly candle and then goes straight back, but you have to accept that risk.
Yeah.
But yeah, I'm looking at it thinking, well, yeah, it's definitely there. It's just a question of, can it do it for you? Oops. That's the other thing to get on. Get your EMA on now, particularly if you're looking at this on a 1 minute. You see it's already starting to creep down. So if you want to stop now, you could sort of go, well, stick your stop up there, get through the EMA, and then you're wrong. As each minute that goes by, that EMA is going to get closer and closer to you, so then your stop gets smaller and smaller effectively. We're getting, how long have we got? You know, 2.5 minutes. It's, you might be right, Joey.
Never wrong, Rick.
I hope not. I hope not, mate. But it ran out of steam. I give you that. But like I said, would you buy it down here? I don't think it's got enough for the upside yet. That's still the line for me. That little pocket of low volume, it was the level before. It's the pullback to these lows. It's the EMA. That's your point to find out. If it stays below that, I still think the move down looks good.
Just the way it was trading like up in the 20s, high teens, it looks like it really likes it up there, and I felt like we should be trading back up there at some stage.
Fair enough. You got to turn that into a trade then.
I've got enough today.
You've had enough.
It's traumatized.
He's got it all right. There's no need to do any more.
It's stressing me out. No, it's not that. Just, I wish I had more screens and just, too reactive. It's just, got 1 cigarette left.
Oh, the things that feed in.
I don't even have a footprint like that.
There you go. To be honest, I don't think you need a footprint for a trade like this. Like, this is one way, well, if you're still short, let's say, you look at that and you go, well, I know where I'm wrong. I know what I'm trying to get. This is that bit that you have to sit through and go, I know I could be wrong here. I'm not proved right yet. It needs to break 06.6. If it does, you start feeling more confident on it. It's come to that final minute. This possibly is the attempt to get through the low. If it does it, and if it closes this candle down here, I think you might get some people come in and try and sell it straight off. Here we go. I think the delta as well. That's just gone down 200 on that last little push down. So this is your kind of moment of truth.
And it's the kind of, you want to see the bonds hold too, because it's kind of the prey of other people just absorbing the interest while it's there. Like, nothing's really changed, so.
Yeah, I'd be less worried about the bonds. I'd be more looking at the euro if I'm looking at anything here. If you're trading gold, you want to be looking more at the euro. The euro's down here now. So the euro's actually through its recent lows. So it took out the lows of this morning over 07. So this is potentially the big chance now. There you go. 3 o'clock hits. Let's see if it can do it. It's had the little pullback.
It's trying to.
Yeah, it's certainly picked up a bit of pace there, didn't it? Possibly a bit late. This way you want to see it then starts to try and push through the lows.
There you go.
There we go. Now we're in business. You want to see it hit that 200 out as well. If it hits through that, you got to be feeling pretty good. There you go. It just takes it straight out.
That could be exit, though.
Is that your exit? I told you lost on the bid, yeah?
Yeah, like I say, it depends what you're looking for. Yeah,
I
if
think
you,
it's only trading 200.
That was just a border proposition. It's going out.
like I say, you look at that on a 15-minute now. If you're looking for down here, you're through that low like that. This is my point, that now you can feel relatively safe. That as long as it's staying below 06.7, you're looking all right on this now. And you've got the potential for that continuation. Yeah, you're knocking out any reasons to buy. Like I said, ask yourself, why would you buy it here? And you're running out of reasons to buy it. I think for every tick down it takes, the number of reasons to buy this, until you get to a point where you start going, gold looks cheap, then you've not really got much reason to buy.
You want to see like a big capitulation type thing?
Sorry?
You want to see like a big capitulation?
Yeah, you want to see, to justify buying, I think you want to see a big flush out.
Which is really going to see that.
I don't think, not from this bit, no. You're just seeing it pulsing down. It sort of has a little pulse down, it sticks, then it pulses down again. Any little bounce back, it ticks up and it just dies and then gets pushed down once more. So, like I say, if you're going for the low, you're not even halfway there yet. So again, this is the bit you have to kind of just step back and still accept you could be wrong. That's the hard bit, but the chance of being wrong and actually really losing on this is getting smaller and smaller and smaller. This is where your EMA comes in. If you
down to, well, my chart anyway, down to 9 something. 09, is that right?
yeah, okay.
09.
I'm looking down there. I think 98. Oh, your EMA now.
I've got a 1 minute chart. You've got a 15 minute chart.
Yeah, it's 15. So yeah, I still think 99. Oops.
Did it trail the EMA the whole way down?
Yeah, that would be the way. If you want to.
Like 98 socio EMA or something.
Yeah, that's the other way. You could go, well, 98, I might take something off. It depends how it trades it. That goes 98 and just charges through it. You've got to go for the lows, 95, and play that as that's the big trade. But yeah, if you want to stay in this now, you could just trail behind the EMA. It's a good way of just stopping you getting tempted with oh, it's gone a bit flat down here now. I don't like the look of it. Maybe I should bank it.
I think so. I think it's a good thing to keep an eye on. I mean, we're looking at it.
Yeah, it just gives you that little bit to sort of just keep the idea running.
Stay in the trade, haven't you?
Exactly.
You've got a reason to get out if you need to at the same time.
Yeah. Rather than
It's
the
structured. Yeah.
Yeah, rather than the standard, oh, but I'm up, I could bank this, I could bank it. Because all the time, even if you don't look at your P&L, which I always tell people don't look at your P&L, you know it roughly. You roughly know you're in from 10.6, so you're 40 ticks on side, plus wherever you added on this, so 40 ticks plus a scratch, you're 40 ticks up. Doesn't matter how much you say don't look at your P&L, you know exactly what that number is, times by how many contracts. So at least you can go, well, it's there, that's my stop. You're a bit more comfortable on it.
Held it perfectly on the
Yeah, well, you saw it on, it's a good example of it. If you tried to play the T note, or the 5 here, on the back of the data, it's good for these sort of creeping continuation moves. That if you just sat with that and said, well, I'm going to let it go. Yeah, you didn't get out. You wouldn't have got out much better off than if you'd stayed in there. There we go. Now we're in business. You wouldn't be much better off, but you're giving yourself the chance, because what you don't know is whether this is just going to go and go and go and go. And if you think it's got the potential to do it, that keeps you in the trade. It's a bit like this gold one now. That might be it. But if it's not it, I don't want to have got out there. So it's a mechanism to stay in.
Definitely going to incorporate that on news days.
Yeah, like I said, there's another one you can bring in on it, and you can bring in an AMA. And what an AMA does is it sticks much closer. I wouldn't suggest that the gold move here is fast enough to justify an AMA, but I'll.
I mean, we still didn't see that exhaustion that I want to see. You want to see, take out like 10, 20 prices, 15 prices.
That's it. There you go.
I guess you really just, you got to be
There's your AMA.
focused in zone.
The thing with AMAs, they don't work so well on slow moves. These are good for when it really starts to accelerate. So something like this starts to accelerate, the AMA will catch it up much quicker than the EMA. So if you really want to when you reach the point where you think, oh, this is actually really accelerating, then you can use your AMA to sort of really try and track behind that. You think the Euro's going as well, that's going to help you out. So the Euro's on its way. Euro's really pushing now.
Yes, and that's
Seems like everything's strong.
Yeah. This is that whole idea of the structure play afterwards. Some of these moves are far better after the data, because this is now effectively markets getting on with what they want to do. So here's the 98s coming up. This will be an interesting one, what it does here. You really want to see it trade it. The worst thing this can do is not quite touch it. But this is where you'll find out either whether it's got more legs in it, or whether this is just going to die out. There we go, 4 more ticks. But you see it's moving very, very tight now with the Euro, which is always going to help you out. As long as those two are moving nicely together, It's worth then going and checking if you've got any significant levels in the euro here, which, as far as I can see, well, we haven't been down at these levels for a long time in the euro. Last time we were down here was 2022, and the next level I've got in the euro is 0530.
Where is the current economic situation?
There you go. That's the next level down there for the euro. So you're moving in some pretty open space here, I'd say. The real frustration now is that it didn't quite reach the level. So it never really gave you the chance to make that decision. These are the hard ones. If you're still playing for the big move, you've still got to keep your stop up here. So the moving average is great, but it starts looking very uncomfortable because that's a give back of about 70 ticks if it stops you out, and you end up with a reasonably minimal winner if it stops you out. The point here being you don't know that it will. Don't want to give up because your last thing you ever want to be thinking is, oh no, I've lost 40 ticks. You haven't lost 40 ticks, you didn't have them. It's just you're not as well off as you were. Yeah, exactly. Like if you really wanted those extra 40 ticks, you would have got them. You should have got out, but you didn't. Therefore, that would suggest that you didn't think that it was worth it, and you think there's more in it. So
that's why you have to keep that approach consistent, don't you? Because if you chop and change that, you're going to be
yeah,
all the time.
Absolutely. You end up giving it up here and then watching it do another 100 ticks. And so you put the work in, you put the initial risk in, and you've got paid 40 ticks for it. Whereas you initially were only risking 20 ticks. If you get paid 200, that's well worth it. It's one of these things that you have to make that decision yourself as to what precisely you're trying to achieve with a lot of these trades. Because I think justifiably, from what Joe was saying, you could well have been out of this as it came down towards 06 and stalled and said to yourself, well, that's good enough for me. I'm happy to give that up. Might transpire that you're no better off having stayed in it, but you've given yourself the chance. It'll be really disappointing now if this comes back. It does feel like the gold move seems quite an excessive bounce compared to the euro. Euro's done 10 ticks, the gold's done 70. Seems a bit much, but this is where that moment of frustration could come in if it starts sticking through the 06. But you know, it's just come back to 06, it's ticked the level, it's probably on your moving average now. There you go, it's traded the moving average, it starts to tick back, you're still looking okay. And it's also what it's done as well on this move back, it's done that with a bit more pace. Straight away it's come in, it's given it a bit more of a sort of bang down. The delta started ticking down again. You saw on the bounces, the delta didn't really tick up that much. It sort of drifted up. It felt quite an easy float up. That's why I sort of described it. It was just like floats off the low. That's exactly what makes people panic, because you think, oh no, this could just keep on floating and floating and it's trading tens. And in the worst cases it does, and you have to get out, because as much as you think to yourself, this doesn't look right and I don't believe it's really going up, there's a point where the higher and higher it gets, eventually everyone does start to believe it is, and then it goes. So there is that risk to it, but you have to kind of just remember that this is a float. Don't panic on it to start with.
Kind of like because it's so thin, it like searches for liquidity.
Yeah, it does that. And
probably a lot of games going through because it's just so thin.
Well, you just got to think, there's a lot of people, we've just been talking through this and the way it's moved and how it's done it. There's a lot of people who've been watching this, passively selling this on the way down. A lot of people who possibly chased it into that final bit thinking, there we go, it's gonna break it, it's gonna break it. And you've then, as it starts to turn, a lot of people thinking, perhaps I should have taken 98s or 99. It starts to tip back and they go, well, go on then 01, and they don't get filled, and then they move their bid up and they move their bid up and they move their bid up, and before you know it, it's trading fives.
Whereas in a thicker market, retail wouldn't really affect it, but I see the retail.
It's not retail, people. It's the nature of where and when people have got in. A lot of this move has been driven by people getting in here. So I view them as more sort of short time frame. It's people like us. We are exactly the kind of people who are going to start to panic when it flies back 50 ticks in your face. If you were selling this because you think gold's overpriced, this is going 2,500, 50 ticks back is nothing when you're looking for 1,000. But if you're looking for a break of the low today and you've got 4 ticks away from it, or away from the next point to break, you do start to worry when it goes 10 back, 20 back, 30 back, you start panicking. So it's basically a load of people like us going, oh no, quick bank it.
So you're going to detach the emotion from it.
Yeah, this is why I was, and partly from my own perspective, to stay in a trade like that, I got to kind of talk myself through the mentality of what's going on, why I don't want to get out, what I'm looking for, what would be the reason to get out. Because I know that I'm exactly one of those people who would have gone, should have given it up just above 98, and then it ticks back and I go, definitely should give it up, and it ticks back, you know, why haven't you given it up? And it ticks back a bit more, and you're like, screw it, just get out, and then you watch it go again. And the worst bit of that is if you watch it tick up and up and up, and then you go on, just get out, you get out, and then it ticks back, and now you're selling O2 and thinking it's going to go. And if it doesn't go now, not only have you chased it back and got out at 05, you now sell old O2 and take your loss at 05.
So what should have been a good day turns into a bad day.
Yeah, exactly. You've ended up basically taking 30 tick winner and then losing 30 ticks trying to play for the next leg of the move because you felt you were owed that to start with. Often, if you've got a decent position, you're better off to not give that up, even if it ends up being that you give it up for a small loss or a not very big win. That's a better choice than giving it up and then chasing after and after that. Comes up in Reminiscences of a Stock Operator. Anyone's read that? It's a good book, it's not brilliant. I remember when I started, everyone was like, you've got to read this book, it's everything about trading. It's a good book, it's an interesting story, but I think it's quite antiquated now. But one of the things that the guy emphasizes in it is it's a story about Jesse Livermore, who's a trader in the sort of early 1900s. One of the things he talks about is if you've got a good position, don't give it up. As soon as you give it up, you're then executing at prices that you don't want to be trading at. If you wanted to be selling it here, you'd be selling it here now, adding to your position. So if you're not selling it here now, the last thing you want to do is get out and then sell it here, because you already said to yourself, this isn't a good place to sell.
Looks like you might be getting that pattern too, where the short ends are trade a bit higher, or the longer end's going to be a bit lower.
Well, yeah, long end's not completely rolled over, but it's definitely rolled over a large chunk of this. And in fact, sorry, the 30 year has completely rolled it over. The 10's on its way back. So yeah, it's
Actually, the 2 years.
Sorry?
The 2 years rolled over more than,
Well, 10 years below the CPI starting point. Sorry, the 30 years below the CPI starting point, the 2 years nowhere near. The 2 years only just at the high, or is on the high of the first minute.
Oh, look at the ES.
Oh yeah, it's definitely the wrong thing then. The S&P's gone lower, but it's sort of stuck in a range. So here you go, you're back to the 04 and a bit. This is possibly the point where you end up giving this one up, I think. The difference this time is the euro has ticked up. The last time we were up here, when we were trading here, the euro is 78. Now you've got the euro at 84, so your reason to not give up the first time isn't there the second time. So if you are feeling a bit unsure on this, I think it's probably quite reasonable to think you may end up giving this up here. This way, you stick to that moving average and say to yourself, well, I'm not wrong yet.
I'm out, man.
Yeah, it's not feeling good.
Yeah, I'm debating, to be honest.
Sorry?
I'm debating to get out.
Debating giving it up.
I might just give it up, to be honest. Yeah.
Well, this is the moment of truth. That euro is really messing this trade up, I think. And you're starting to tick through. This is the point someone was asking about stops, and I was saying about the nature of, like, do I want to place stop or do I want to just manually do the stop? If you place the stop just above the EMA, you're out now, and you've got flicked out. It didn't do that much there. It kind of sat there. It deviated through the level a little bit. It didn't do a great deal. If this goes and euro still sits up, the more time it trades up here, the fact it's back there, I wouldn't fancy that too much anymore. Because this time it didn't just tick up and back, it's now just up and it's trading higher. So then this is the point where you have to go, yeah, don't particularly like it, give it up. It could be a frustrating one. This is always the problem of where do you stop out, because the original level to break was 06.6. So you are giving it up based on the short time frame at possibly the level it's going to go back from. It's a really difficult, there's always this kind of way up of what to do in these situations. And this is where now, if you are going to go for the revenge trade of selling it through the low, you've got to be really clear on what you're going to look for and where you're going to do it. I think for me, it's that low there. you go for the 01. It's got to come down there with a lot of volume. It's got to come down there fast and slam through it. And then you've basically got the space between 01 and 99 to sell on the basis that if it breaks 99, it'll break the 98.7 level and then it'll go. But I wouldn't, the last thing you want to do is get caught up here now, going, oh no, I got out, now I went back in, and you just end up messing around. And before you know it, you've lost 30 ticks in a 5-tick range. And you don't know how you've managed to do that, but you've lost everything you made on the initial move.
Computer's going out the window.
Yeah, you've broken your screen. You called a lot of people a lot of names. Vowed to never buy anything gold again. And quit trading. But that's not going to happen. We're going to wait and we're going to sell it through 01. Or at least you guys can a bit later. Yeah, S&P seems to have completely died out now. Right, I'll see if anyone's put any comment in here, otherwise. Right, what charts do you use for morning analysis and what tools do you use for the open? Okay, slightly off topic. What charts do I use? Standard, I would always, with every prep and all my charts, I use a profile, a 60-minute and a 5-minute/1 minute. What tools do I use for the open? The ladder, basically, that's it. Yeah, for any open, I don't, we'll perhaps talk about this a bit more as we go forward, or we can start looking at a few more opens. On the whole, opens are not really the time to be jumping into a trade unless you've got a really clear reason to do so. News, that you're particularly out of line with something, that you've got a very clear structure reason to be doing it. On the whole, I would treat an open like playing poker, that you will fold most of your hands, i.e. you don't trade most opens. There will be one where there's a big chance that's the one to go for. Otherwise, I would stay away from most opens. And do you have a list of recommended market replay events? Yes, I thought I posted this, but I will post it, and there's multiple different events that you can trade. I say events, what I've got on there is a number of different setups for people to go and have a go at. So you get to see breakouts, reversals, different things. So it's a chance to sort of practice different skills. So I'll post that. What I might do, I'll post it and then I'll work on a table of specific things. For data points, I don't need to tell you when they are, just go back and look up when previous CPIs were, etc., etc., etc. Go and look them all up and go and trade them. Great way to learn any kind of order flow is to trade these events without charts. Because if you trade them without charts, you then just trade what you see. Trading without charts, also trade them without knowing what the data was, because then you become much more responsive to the way the market trades rather than your assumption of what the market should do. Prime example was treasuries today. If I'd not looked at the data, probably would have bought that. But seeing the data, you go, no, I don't believe this can keep on going, so therefore you don't. I actually think there's probably a lot of value a lot of the time. If you just didn't have a chart and didn't know the data, some stuff you'd do much better on. It's the stuff that's a massive outlier you won't, which is mainly the stuff you want to trade. But go and have a go at those. I'll also try and create a bit of a list of closes. Although again, closes, if you want to practice closes, I would suggest you go and trade every month end is the best way to do it. Realistically, you're not going to trade closes every day. Month ends you will want to. So you can go back and practice, what's it, 2024 now? So you've got about 70, 75 month ends to go and have a go at. So worth doing. And then if you want extreme closes, any periods with high volatility, Feb 2018, March 2020, they're probably the two key ones to go and have a go at. Go and have the closes there. Summer 2022 is probably quite good as well, but Feb 18 and March 20 would be the good closes to have a go at. We've got option expiry on Friday, so I'll talk a little bit about that. I will also set you guys up Friday for a bit of a order flow exercise challenge. So I'll leave you guys to trade the option expiry using that and go and have a go at that as well. So tomorrow we'll cover the last of those special circumstance trades, and we'll do a little bit on correlation. That should start at 10, unless of course trains run a bit funky, so it might be 10:30. I will let you know, but assume 10 unless you hear otherwise. See you tomorrow.